Okay. All right. 1, 2. Okay, I think we're live on YouTube as well now. Okay, so you're welcome again to the Q&A session. What the heck? Okay. So you are welcome again to the Q&A session this evening as we try to answer some of the queries you have, some of the challenges you have in the exams. So what I want to do is, there are a couple of questions that will require me to write on the screen or write on my screen. Hi, I'm Susan. I'm Sorry. That will require me to write, whilst there are others that will require me just to speak. So if there are any questions, you raise your hand, you bring it up, and then let me try to answer some of the questions for you quickly. And then when we see the ones that will require me to show something or demonstrate something, then I'll bring down my screen on that. So if there are any questions, you raise your hand, you bring it up, or you can put it in the chat for me, and I will answer you in that case. So please, I need a crash course on IFRS 9, that's financial instruments, and then IAS 19, that's employee benefits, and then IFRS 2, share-based payments. Geez, that's a whole lot of serious level 3 situations coming in. So IFRS 19, I think that is for almost everybody on the call here. It's like almost everybody on the call so far is doing CRM. FR, policy PSA situation. Then what? IAS 19, and then IFRS 2. For those of you joining us on YouTube, you can put your question in the chat for me. I'm going to read all your questions and reply as well. This is a Q&A session as we try to answer some of the challenges you have in the various things that you're studying. Any other question for me? So this is from George, IFRS 9, IAS 19, and IFRS 2. Any other questions for me, please? Pull it up and then let's see what we can do. Let's see if I can share my screen. Okay. Okay. So let's see. So my first query coming up is in relation to, okay, on YouTube, Nicholas Ravini said variance analysis. What exactly on variance? Give me some specific questions. What on variance, Nicholas Ravini on YouTube? Give me some specific thing about variance. Variance is broad. What should I talk about? What's your challenge there? Give me something specific that I can.
Nhyira, I think there's some problem with your mic, so you say you can speak through the mic.
Why it's not coming out? What's the issue? Oh, sorry, it's true. I'm on the wrong mic. I'm on the mic from the PC. That's one of the good mic at all. Thank you for that.
Very, very clean now, I guess. Let me know.
Yeah.
I've changed the mic. Is it okay now?
Yes, sir.
All right, thank you. Okay, so IFRS 9, IAS 19, IFRS 2. I mean, these are broad issues. I don't know what specific, I think you said a crash course. That is a very broad issue. I will get into that as well. Now, I see some of you guys joining. If there are any specific questions you have for me, something you want me to share my thought on, you raise your hand, I bring you up, then you share your thoughts. Or better still, you can put it in the chat for me, and I'll provide you with some answers that you have in that case as we begin to look at our discussion here. Now, so as I gather my question and go into what we need to look out for, there are a couple of issues that we have generally spoken about that you need to pay attention to. We mentioned that for the purpose of how we want you to go and to pass the examination. Okay, so Nicholas has brought something up. What material makes material yield and then reversal of variances. Okay, reversal of variances. That's a lot of things coming in there. Okay, that's fine. We're going to be looking at it. So mix, yield, I think that's management accounting, and then reversal of variance. That's about management accounting. Okay. So it means so far my questions available are the ones relating to this particular issue in that particular case. Let's see. Like I was mentioning, there are a couple of general statements that we mentioned when it comes to your examination. And we have mentioned that as you go into the exam hall, whatever subject you are writing, there are going to be theories there. So make sure you answer the theories first. We have mentioned this over and over again. So make sure you answer the theories first. I cannot overemphasize the importance of that. Management accounting, PSA, FR, audit and assurance criteria, everything is theory. But the papers that have some theories and some calculations, you want to make sure that you go in the theories first. But most importantly, spend time to read the questions and start with what you can do best first as well in that case, because that is going to be very basic and that is going to be very important in that regard. Now, so let me go in and start with some of the questions I have here and share my thought on them. IFRS 9. Now, the issue about IFRS 9 is about financial instruments. And then we spoke about the fact that when it comes to financial instruments, it is broadly going to be any transaction that creates an equity on one hand, any transaction that creates equity on one hand, that creates assets on one hand, and then equity and liability, equity and or liability on the other hand. So any transaction that results into creating an asset on one hand, equity and liability on the other hand becomes what is referred to as what? A financial instrument. So broadly, we made mention of the fact that there is a key question that we need to ask ourselves, and there are certain words that we need to pay attention to. If in the question we are told that, oh, the entity in the question is buying, okay, so the entity is buying, or the entity bought, or the entity purchased, or the entity acquired, whatever words that the examiner uses, bought, buying, bought, purchase, acquired, whatever it is that the examiner says, it means that we are going to deal with financial assets. Okay, it means we're going to be dealing with financial assets. As far as we are the ones buying, we are the one purchasing, we are the one acquiring, we're going to be dealing with what? A financial asset. But on the other hand, if the question reads that the entity issued, okay, the entity issued, the entity sales, okay, then it means that we are going to be dealing with either an equity instrument and or liability. So the trick is to identify in the question that we are solving, who the heck is up? Is it an equity? Is it a liability? What it is that is up at the end of the day. So if the entity is buying, the entity is purchasing, the entity is acquiring, that is a financial asset. If the entity is issuing, the entity is the one selling, then it becomes an equity and or liability. But the question we ask ourselves is, if we are in the books of the entity that is issuing or the entity that is selling, Then we need to find out, when do we classify a financial instrument as an equity instrument, and when do we classify it as a financial liability? So we made mention of the fact that a key question is going to be asked, and the answer to that question will determine how we are going to be treating the thing. That is, does the entity has an obligation to pay? So does the entity have an obligation to repay? That is the key question. So in the question, we need to find out, is the entity having, or does the entity have an obligation to repay? That is the golden question. And we can have two answers as always. Hell yes, the entity has an obligation to pay. Nope, the entity has no obligation to pay. Certainly, if the entity is issuing but has no obligation to repay, that is directly an equity instrument at the end of the day. But if the entity has an obligation to repay, then that is a financial liability, because they have to repay the amount at the end of the day. So to determine whether a financial instrument should be categorized as a debt instrument or an equity instrument, we ask ourselves the golden rule question. And the golden rule question is, does the entity have an obligation to repay? If yes, it is a financial liability. If no, it is an equity instrument. But we made mention of the fact that anytime an entity issues a convertible loan note, anytime an entity issues convertible loan notes, anytime an entity issues convertible loan notes, then quickly, according to the IFRS 9 standard, that loan note must be divided into the equity instrument and the debt instrument. Very important. So if the entity acquired convertible loan notes, we don't care. That one is still going to be a financial asset. No P on that. That one is still going to be a financial asset. No problem on that. But if the entity is issuing convertible loan notes, the standard states it must be splitted into equity and then debt, because it has two components in there. The debt component is calculated by simply discounting the cash flows on the loan notes. Discounting the cash flows on the loan notes. Using the effective interest rate. Using the effective interest rate. Using the effective interest rate. So that is the issue about that. And once we have the debt instrument, the equity is simply going to be the proceeds minus the debt. So the balancing figure of this is what gives us the equity instrument. So that is how we deal with convertible loan notes. Very sweet, simple, straight to the point at the end of the day. But then we come and say, hey, assets, how do we account for financial assets? Now, usually the way we account for financial assets, can be based on two things. Either the entity is carrying it at fair value through P&L or at fair value through OCI. Now, the difference between this is that if the entity is carrying it at fair value through P&L, then any transaction cost they incurred must be written off in the P&L. Okay? Any transaction cost is written off in the P&L. And then also any fair value gain or loss is recognized in the P&L. Simple. And that is the fair value through P&L. And usually these are for trading purposes. Maybe the entity bought the financial assets for trading purposes or to make some short-term gain. It expects to sell it within the shortest possible time. Then it is going to be at fair value through P&L. The transaction cost is going to be written off in the P&L. Any fair value gain or loss is going to be recognized also in the P&L. If it is at fair value through OCI, the transaction cost is included in the initial value of the financial asset. So any transaction cost incurred here, is included in the initial measurement of the financial asset. In the initial measurement of the financial asset. in the initial measurement of the financial asset. Then in that case, what happens is that any fair value gain or loss is recognized in P&L. Sorry, OCI. It's recognized in other comprehensive income. So that is the distinction if the entity buys it. Now, please note that this is done if the entity buys a financial instrument that whose fair value can be determined. So this is if the entity buys a financial instrument whose fair value can be determined. Okay? Whose fair value is measurable. Whose fair value is measurable. But if it is a financial instrument whose fair value cannot easily be determined, especially a debt instrument, so if the entity bought, say, a debt instrument, then what is going to be happening is that we are going to be carrying it at the amortized cost schedule. Okay? It is carried at amortized cost. It is carried at amortized cost. And that is the deal there. So if the fair value can be determined, fair value through P&L, fair value through OCI. If it is a debt instrument and its fair value cannot easily be determined, it is going to be carried at the amortized cost. So that is the deal on the financial cost, financial asset in that case. Then you come to the issue about financial liability. Financial liability doesn't require any miracle usually, because with financial liability, any transaction cost that is incurred is subtracted from the initial measurement of the financial liability. So the initial measurement is the fair value less any transaction cost. The fair value less any transaction cost. So any transaction cost incurred by the entity will be subtracted in arriving at the initial amount for the financial liability. Then right from there, on subsequent measurement, it is carried at the amortized cost schedule. It is carried at the amortized cost schedule. So basically, when we talk about the issue in relation to financial instruments, that is how we deal with the financial liability and then the financial asset. Yes, Martin?
Yeah. So, about carrying on either OCI or true profit and loss. What about if the question is challenged whether they are holding it for maybe for long-term strategic plan or maybe for trading purpose? In that circumstances, can you opt for any of the treatments?
If the question is quiet and we don't know the main reason or rationale for the entity's acquisition of the financial instruments, yes, then certainly we can opt for any of them in that particular case and then see how you go about it. So you can opt for any of them and then you can write a brief explanatory note in your working sheet to state why you are accounting for it, and then you will be okay. Because once the question is quiet, you will be able to go through that.
I think my second question also is there was a question that maybe I was looking and they said that the entity maybe they recognize through profit and loss, but they went further also and said that they are holding for long-term strategic decision. So in these circumstances, it means that what the entity have done is wrong. So you need to reverse to a true fair value through OCI or what?
No. You don't. It's about policy. Whatever the entity is doing, they can hold it for long-term purposes, but they will decide to bring any fair value gain or loss in the P&L. So it's the company's policy. They are not wrong. They are right to do that. They are right to do that. So even though it is for long-term purposes, they have selected to account for it. This is a method. we have, or the standard just gave a guidelines that, oh, if it is for long-term holding purposes, then it should be at fair value through OCI. If it is for short-term, then it should be fair value through P&L. But it's a policy. The entity can decide and then use whatever thing it wants to use based on its judgments. So the entity is not wrong, even though it is for long-term purposes. The entity can select and do at P&L, and that will be right.
Okay, thank you.
All right. So that is the issue there when it comes to dealing with financial asset and then financial liability under financial instruments. Basically, these are the principles we need to understand. Now, pay attention to the fact that it is the effective interest rate that goes to the P&L accounts, not the coupon rate. It is the effective interest rate, because when you're dealing with, say, a debt instrument, and the entity bought a debt instrument, you are going to carry it at amortized cost. So you're going to prepare your schedule here, balance brought forward, interest coming in, then payment, and then balance carry forward. The interest is going to be based on the effective rate. That is what goes to the P&L account. And since the entity is buying a debt instrument, that becomes a receipt. So that will go under the statement of profit or loss as part of other income, receipt. But if we are dealing with financial liability, the same amortized cost schedule will be prepared. But this time around, the entity will be making payments. So the effective interest rate will be part of finance cost in the statement of profit or loss, So whether you are, if it is an asset, the entity bought the debt instrument, the effective interest rate, that is what will be added to other income. But if the entity issued a financial liability, then we are going to be adding it to the interest expenses in that case. So that is what you need to understand when we talk about dealing with financial instruments under IAS 19. I see some of you guys coming up. This is a Q&A session. So if there are any questions you have, you can put them in the chat for me, or you raise your hand, I bring you up, then you ask me the question, then we go into it in that case. Yes, Oxbet.
Is it possible that bond can be issued at premium, and what is the treatment?
Bond can be issued at a premium, and what is the no, rarely would that. It will be redeemed at a premium. It can be issued rather at the nominal value or at a discount. It cannot, if it is, no. It's, I don't know. Where did you see anything like that somewhere?
No, I'm just imagining, because
No.
I only see them issuing at discount, but I'm not.
Yeah, at par or at nominal value. You can't issue a bond at a premium. You cannot issue a bond at a premium. I don't know. It could be in practice, but I've not seen that anywhere. But it's at a discount or at a premium. Sorry, at a discount or at a nominal value. These are the two available. Okay, so that is it about IFRS 19 there. Let me take some other questions here as well, because I don't want to be just one-sided. Clement is saying, please, any illustration on planning and operational variance. So that is management accounting. Let me talk about that real quick, then I'll come back to other things. So planning variance and then operational variance. Now, the idea about planning and operational variance is simple. It's actually a breakdown of the material price variance. So the material price variance can be further divided into the material price planning variance, then the material price operational variance. Now, the planning variance has to do with looking at the differences between how much we budgeted and the actual price for the products for the period under review. So for instance, if I want the material price planning variance, it is going to be the standard price that I set for myself, or the budgeted price that I set for myself, okay, multiply by the general price as at the time we were buying, minus the general price as at the time of purchases. As at the time of purchases. Then we multiply that by the quantity of material purchased. We multiply that by quantity of material purchased. We multiply that by quantity of material purchased. Okay, so that is the material price planning variance. We are looking at the efficiency of our procurement department in their budgeting system. So if you budgeted to buy something at say $20, but then when you were buying it, the general price were $15. Why could that be? Yeah, it could be there is a difference between economic conditions, or it could also be because you are a poor person or you were not, your budgeting system was not enough. So that is the idea about the material price planning variance, the difference between what we budgeted for as compared to what the general price was at the time we were buying. But then not only do we want to look at the budgeting efficiency of the entity, we also want to look at the efficiency of the procurement system, their negotiation skills, and how they are able to procure goods and services. So to look at their efficiency and their negotiation skills, we have the second one, that is the material price operational variance. The material price operational variance. The material price operational variance is simply the difference between the general price at the time of purchases minus the actual price paid. So the general price at the time of purchases, the general price at the time of purchases minus the actual price paid, multiplied by the quantity of material bought. Multiplied by the quantity of material bought. So what does that mean? It simply means that, for instance, if we have the general price of the product is $15, and when we were buying, we paid $25. Why the heck did that happen? Why is it that everybody is selling at 15, but we bought at 25? Now, it could be because of the fact that there is, again, economic, because maybe this 15 will be a minimum price legislation that the government has set, but then people are not willing to sell at that price. So in order to get our material, we have to go to the black market. And when we go to the black market, the price that is available at the black market is $25. So that could be a reason why the entity is paying more. Or maybe our production department or the procurement department is just lazy, lousy, not qualified to do their job at the end of the day. And that could be a reason as well. So if you ask about the material price planning variance, that is the difference between the two. The material price planning variance is looking at the budgeting ability of the procurement department of the organization, whether they are able to effectively set the budget for the goods and services in question. Then the material price operational variance has to do with their negotiation ability, how much they paid as compared to the general price at the time of the product. So if you ask about the material price and material planning variance, these are the things that you need to understand there. These are the things that you need to understand there. Okay, so if there are any questions, you raise your hand, I bring you up, or you put it in the chat for me. It appears that my class here is dominated by CR and FR students. So I'm just going to get excited about that and talk about a few things, and then we will continue with our discussion. Now, another thing that has come up that I'm told I need to share my thought on quickly, it's about IAS 21. So I'm going to share my thought on IAS 21, effects of changes in exchange rates. Effects of changes in exchange rates. And this is FRCR related. Now, what do we have to do when it comes to dealing with the effects of changes in exchange rates? Very simple, very sweet, very nice, that we need to look out for at the end of the day here. The idea here is that we need to look at the exchange rate. It's simply the rate at which a transaction, the rate at which one currency is exchanged for the other. So for instance, currently, If a dollar sells for $1 will give you whatever, let's say 9 CD 25 pesos. That is the exchange rate, the rate at which one currency can be changed into another. Now, there are times when an organization engages in foreign transactions. The organization engages in foreign transaction, and we would have to translate that foreign transaction into our domestic currency. So there is also what is referred to as the functional currency. In a simple language, we say that the functional currency is simply the currency of the reporting currency of the entity in question. So certainly if the company is a Ghanaian company, then the functional currency is going to be what? The Ghana cedis. Okay, if the company is a Nigeria company, then the functional currency is going to be the issue in relation to the Naira. If it is a UK company, then the currency is going to definitely be the pound at the end of the day. So we need to know the functional currency. That is the currency of the reporting currency of the entity in question. Then we need to also look at issues relating to monetary items, and then non-monetary items. Monetary items and then non-monetary items. In a simple language, issues such as inventories, okay, property, plant, and equipment, all these are referred to as non-monetary items at the end of the day because they cannot directly be converted into cash. But then if you have issues such as let me say this, some of you are doing PSA. There is an IPSAS on foreign transaction. So the same principle applies in IPSAS. So for those of you who are doing PSA who are on the call, like this thing is applicable in PSA. So make sure you don't brush it over because it is applicable in PSA. I think, let me just look at my IPSAS book and get a IPSAS relating to that. Give me a moment. It just dawned on me that I need to notify you on that. Okay, so no, that is IPSAS 4. IPSAS 4. So it has an IPSAS implication, so you make sure you are aware of that. So we need to distinguish between monetary items and then non-monetary items. Like I said, the non-monetary items are things like inventory, things like PPEs, Those are the monetary items. Sorry, non-monetary items. The monetary items are things like things that can be exchanged into cash. So things like trade. No. Why? That is IPSAS 4. IPSAS 4. So it has an IPSAS implication. Sorry. Having a feedback from my. So something like trade payables, trade receivables. These are monetary items and other items because these can be exchanged into cash. So what is the exchange rate? The rate at which one currency can be exchanged to the other. What is the functional currency? The reporting currency of the entity whose financial statement we are preparing. Then we must distinguish between monetary item and non-monetary item. Why is this important? Very simple. The reason why this is important is that we need to look at the initial recognition and then the subsequent measurements. So initial recognition. At initial recognition, the simple thing that we need to understand is that the transaction is translated into the functional currency of the entity using the exchange rate at the date of the transaction. Okay, so the transaction is translated into the functional currency, of the reporting entity using the exchange rate at the date of the transaction. So that is very simple. I mean, we don't require any miracle on that. It's pretty simple, direct, and straight away in that regard. So what does that mean? So let me say that, for instance, let's say that My Love Limited bought assets from China on credits valued at whatever, let's say $10,000. So on 1st August 2021. So let's get the exchange rates coming in. So let's see, this is the exchange rates respectively. So let's say on 1st August, the date of the transaction, 2021, the exchange rate is that $1 is 6.250 Ghana cedis. Then at the year ended, which is 31st December 2021, let's say $1, the Ghana cedi has depreciated more to something else like that. So the question we ask ourselves is, how do we account for this in the books? Very simple. We need to look at the initial recognition. So the initial recognition, we translate it into the currency. So the initial cost of the assets, it is $10,000. Exchange rate is 6.02. So the way you do it, if $1 is 6.250, then 10,000 will be what? You get the idea? So you multiply. It's not every day that you multiply. So you just have to know when to multiply, when to divide when it comes to dealing with this particular issue in that case. So the amount initial cost is now going to be 10,000 US dollars multiplied by 6.250. And that is going to be 610,000 by 6.250. That's 62,500. So this 62,500, remember the thing was bought on credits. I said on credit. So the journal entry is to debit your property, plant, and equipment, 6250. And then you credit your trade payables, 62,500. Now, at the reporting date, what do we do? So this is happening on 1st August 2021. So at the reporting date, 31st December 2021, what do we do? What do we do at the reporting date? So at the reporting date, listen carefully. That is the subsequent measurement. So on subsequent measurements, we translate monetary assets at the closing exchange rate. We translate the monetary assets at the closing exchange rate. So material subtraction, subsequent measurement. We translate the monetary assets at the closing exchange rate. So translate the monetary items at the closing exchange rate. Closing exchange rate. And any fair value loss or gain, any gain or loss is recognized in the P&L. Okay, so what does that mean? But then for the non-monetary items, you carry it at the initial value For the non-monetary items, they are carried at the initial amount subject to any accounting standard you are applying. They are carried at the initial amount. So non-monetary items are carried at the initial amount. Initial amount subject to any applicable standard. Subject to any applicable standard or IFRS. So if you're accounting for it as property, plant, and equipment, then IAS 16 will apply on it. If you're applying IAS 40 investment property, if you're applying whatever standard it is you're applying, if it is an inventory, IAS 2 will apply for it. So for the non-monetary items, if it is a PPE, then probably you do IAS 16, you do IAS 40, whatever it is. If it is an inventory that you are reselling, then you will carry it on subsequent measurement as IAS 2 inventory or whatever it is. So on subsequent measurement, the way we carry the thing depends on whether it is a monetary item or non-monetary item. So for instance, if you come here, the trade payable is a non-monetary item. So at the day that you bought the thing, you owe them 62,500. But at the year ended, you've still not paid it. So since you've still not paid it, we are going to be having the issue relating to that. And so let's get the amount outstanding trade payables at the end of the year based on the exchange rate. We still owe 10,000 though, but then our exchange rate coming in is now 9.250. 9.250. And because of that, it becomes an amount of 92,250. Sorry, 92,500. 92,500. So that is the closing balance. But if you compare, there is what we call unrealized exchange loss. Now, actually, it's supposed to just be exchange loss. I'm adding the unrealized because I want to explain a concept somewhere. So it's just going to be an exchange loss. It's a loss because your liability is going up. So 92,500 minus 62,500. And that should be about, Ghana cedis. Sorry, this is Ghana cedis. And that should be an amount of $30,000. So this $30,000, you have to take it to the P&L because the journal entry for that is to debit profit or loss. It's an expenses. And then you credit your...
It's 30,000 cedis or $30,000?
30,000 cedis. That's why I've written and put CD down. So 30,000 cedis there in that case. So that will be expense in the P&L. So when we go to the statement of financial position, this is the value for trade payable. But the asset will still be carried at the initial value, 62,500, subject to what? Any applicable standard that the entity is going to be applying. Subject to any applicable standard that the entity is applying. Now, the reason I brought the word unrealized loss here is that for those of you who are doing tax, if you remember, we said if an entity thin capitalization concept, the exchange loss that is allowable for tax purposes is the actual exchange loss incurred. That is the exchange loss incurred on payment, not on realized exchange loss. So this one is the accounting exchange loss. For the financial statement preparation in accounting is correct. You take it to P&L. But if you are doing tax, advanced tax or principles of taxation, unrealized exchange loss is not allowable expenses for tax purposes. So I'm bringing this up just to remind you, advanced taxation students, principles of taxation students, again, about a principle that we explained when we're talking about thin capitalization concepts. So this is an unrealized loss because we've not paid it yet. It is when you are paying the loss you incur on the payment, that is what you will be allowed for tax purposes. But this one, you are not paying it yet. It is still for your accounting treatment. So this one will not be an allowable expenses for tax purposes. But from the perspective of our financial statement, certainly we're going to be dealing with that or treating that as an expenses for the year. So basically, that is the idea about the issue relating to IAS 21 that we need to understand there. Yes, Martin.
Israel, so at the closing date of the financial statement, the payables will be carried on 92,500.
Yeah.
At the statement of the financial position.
Yes.
So what about 62,500?
Which 62?
Yeah, at the beginning of the
that is for initial recognition.
Yeah,
but
initial recognition.
At the end of the year, that is not what goes to the statement of financial position. It is the closing figure based on the exchange rate that goes to the statement of financial position. That is why the difference is taken to the P&L. But the PPE, which is accounted for, will be the debits PPE we did will be accounted for as per any applicable standard that we are using. As per any applicable standard that we are using.
So, if this one is not a non-monetary item, like maybe the PPE, how are you going?
That is why we are not translating the PPE. We are only at the end of the year, we are translating the payables because that is the monetary item. You don't translate the PPE because the PPE, after the initial recognition, you're now going to apply your standard. That is what we said here. For the non-monetary items, they are carried at the initial amount subject to what? Any applicable IFRS. So the IFRS will apply. So we don't deal with it subsequently as per the exchange rates. Okay. Yes.
So please, what happens if after you've settled the trade payable, then there is a subsequent revaluation?
Whatever happens on payment, the difference is still taken to P&L. So if you make this payment in January and the exchange rate now, you owe the person $80,000 because your currency has appreciated, then the 12,500 will be a gain, and that will be recognized in that year's financial statement. That will be 2022 financial statement year ended as a gain, exchange gain, that when we were making the payments. So that will be the issue there. That will be the issue there.
Okay, thanks.
So that is the idea about IAS 21 and how you deal with it. So the focus is always going to be on, is the item monetary or non-monetary on the subsequent measurement situation, and that is going to be directing how you are going to be doing the treatment generally at the end of the day. That will direct how you do the treatment at the end of the day. And like I said, the same rule will apply, assuming we are in public sector and a public sector entity bought some PPEs that they are going to be distributing for people. Okay, now they said we shouldn't wear nose masks. So at the nose masks, they were not even wearing it already. So I don't know the purpose for that announcement, but it is what it is. So assuming a public sector entity bought something from outside, they will still apply the standard that has to be applied to be able to arrive at their answer, and that is IPSAS 4, effects of changes in exchange rate. So the key thing is you need to understand what the exchange rate is, what the functional currency is, what monetary items are, what non-monetary items are, and then on subsequent measurements, that is where it will kick in for the treatment of the monetary and then non-monetary item. If there are any questions, you raise your hand, I bring you up, or you can put it in the chat for me. Let me see on YouTube, I have some messages coming in. Let's see. Timothy said, wishing all writing this diet all the best, especially Martin, Pearl, Ike, Eben, and everybody. Okay. So Timothy is giving you something here. Yes, Oxbet.
Yeah, Nhyira, so the monetary item, is it only trade receivables and trade payables?
Anything that can be converted directly into cash, in that case, we can call stocks, shares as a monetary item as well in the books of the company, because in some senses, it could be converted into cash, can be traded into cash. So stocks, shares, bonds, these are all can be classified as monetary items at the end of the day. They can be classified as monetary item. Only that those things, they are not going to be applying in the context of IAS 21, because I mean, you don't buy them and subsequently remeasure all those things at this level of your discussion. You don't deal with that in the standard. Yes, James.
Yes, my question I asked in the afternoon, the spinner and the carveout, and also the console when there's still a remaining interest.
Issue about carve out is where an entity separate a segment of a business and establish it as an entity on its own. So let's say we have a company, NP Limited, and we have 3 divisions. We manufacture and sell maybe condoms, and then we sell sanitary pads, and then we sell baby diapers at the end of the day. So these are the 3 divisions that we have. And then for some reason, during the in the last 5 years, we've seen that the sanitary pads, the ladies have accepted Nhyira Premium sanitary pad a lot. So they like it. So the sanitary pad division is booming, having a lot of things. So we could carve it out. So we take it out as a division and come and establish it as a separate legal entity. As a separate legal entity. Now, the idea about establishing it as a separate legal entity here is that the shares in that new company is owned entirely, usually by the existing shareholders of the company. So that is a concept about spin-off, carve-outs in that particular case, where a division of a business is going to be removed, or a segment of a business is going to be removed, and then we are going to establish it as a separate entity on its own, and establish it as a separate entity on its own. Then the issue about spin-off works in that particular regard as well. The spin-off has the same implication. The spin-off is where not necessarily that we have an existing business. It could be that it could be a division, but not that the division is big on its own. But the distinction between spin-off and carve-out is that with spin-off, what happens is that we could issue a share. So we will create an independent company. We create an independent company. We create an independent entity by maybe by maybe issuing new shares to the public, by issuing shares to the public. So with spin-off, it is about creating a new company. Now, that may not necessarily be an existing business that we have in that particular case. That may not be an existing business that we have as a company. It could be a new business that we are establishing. So maybe we are in condom, we are in sanitary pad, we are in diapers. Then people come and they are like, hey, listen, we like the condoms, we like the sanitary pad, we like the diapers, but how about you having other forms of contraceptive? I don't know. I've forgotten some of the names of the female contraceptive. Oh my goodness. Whatever.
You must remember.
What? I can't remember. Sure. Whatever.
It's really
Yeah. Lydia, Postino and those things. Yeah. Whatever it is. But this time around, we'll call it Nhyira contraceptive, Nhyira after morning pills, that kind of thing. So here with Spinoff, it is a new company we are creating though, but it can be from an existing line of products or business, or it can be an entirely new business. The idea here is that two things can happen. Either we will issue new shares to the public, or that new company we will form, the shares will be owned by the existing company. So Spinoff has some element of carve-out inside in that case. So Spinoff has an element of carve-out in that. It's all about creating new company, but then with carve-out, we create the new company from existing divisions. But with Spinoff, we can create new company out of nowhere, just a new subsidiary we have as a company to deal with a new product idea that we have developed that we don't want to add to the existing product line in that regard. So if you ask about spin-off and carve-outs, that is the issue relating to that at the end of the day. Then when there is disposal, your question is if the entity dispose and retain a portion of interest, it depends on what is happening, the portion that they are retaining. They can retain a portion and hold it as an investment in associate, and that is IAS 28, so that they've disposed of their interest. So they own, let's say, 70%, and then they've sold 50%. So they are left with 20%, but that 20% gives them significant influence. So then after the disposal, that 20% will be accounted for from the date of the disposal in accordance with IAS 28 as an investment in associate. From the date of the disposal, it will be accounted for as an investment in associate. FR students, this does not apply to you, so don't listen. So it will be accounted for as an investment in associate. The another time, the entity will sell, lose control, but will retain a portion for just as a financial asset, and will be accounting for it in accordance with IFRS 9 financial instruments. So in that case, what happens is that maybe still they own 80%, then they sell 70%, then they have 10% left. That 10% left, they want to account for it as a financial asset. So it means from the date of the disposal onward, that retained investment will be accounted for as what? A financial asset in accordance with IFRS 9 financial asset. So it is either the entity is disposing of the entire business, is disposing of just a portion of the business, like illustrated in class, or is disposing of and retain a portion as a significant influence, from which date it will be accounted for as an investment in associate, or if it is retaining to account for it as a financial asset, then it will be accounted for as per IFRS 9 from the date of disposal. Now, once they have lost control, it means after that date, the subsidiary's information cannot be found in the financial statement of the entity. So there will be no NCI, non-controlling interest. We will not add their revenue to our revenue. We will not add their asset to our asset because we have lost control. The only thing we can then account for is the retained investment that we have, in which case could either be an investment in associate or a financial asset as per IFRS 9. So that is the issue relating to the disposal. Either we are selling and we are losing control. We are selling, but we are not losing control, in which case the movement occurs in retained earnings, like illustrated in class, or we sell and we retain a portion as an investment instrument, investment in associate, or we retain a portion as a financial asset. So that is the issue about disposal in the consolidated financial statement as well.
So how do you then determine a gain or loss on the disposal? Is it the same with the is it you only include the interest? Is it the same format? In class, there was no residual interest. So in this one,
which residual interest?
The interest that is remain, like they are accounting for. Hello, sir. You know, in the class, when we're determining the gain, we brought the fair value of the proceed. Then we added the NCA at disposal. Then we less it from the net asset at disposal and then goodwill. But in this case, you could see that there's additional element coming, which is the retained interest or the residual interest. Is it going to change the other calculation, or how is it going to be?
Profit on loss on disposal. Profit on loss on disposal is calculated as the fair value of consideration received, the fair value of consideration received, plus the fair value of any retained investment, non-controlling interest at the date of disposal, goodwill to be deducted, and then net asset at the date of disposal to be deducted. This is how we calculate the value on the disposal. So the fair value of the amount retained, it's going to be, we're going to pretend as though we are selling it, and then you bring it up and add it to it in that case. So that is how you deal with the issue there. So it will be included and added up when you are determining the fair value, the profit or loss on the disposal. So the amount that has been retained is going to be coming there as fair value statement. So that is the issue about that. Then let's see. Yes, Oxbert.
Nhyira, please, effective interest rate. If the effective interest rate is 16, like it is, let's say they say effective interest rate will be 10.
Relax. I'm coming. Relax, I'm coming. James, are you okay on this one?
Sir, can you go over?
The any amount, your question is how, when there is a portion retained, how does that affect disposal? When there is a portion retained, that portion retained is included in calculating your profit or loss on the disposal. So the fair value of consideration received for the portion that was sold, the fair value of the portion that has been retained is going to be added. You bring in the NCI at the date of the disposal, you less your goodwill, you less your net asset at the date of disposal. So yes, the portion that has been retained will be included in calculating your profit or loss on the disposal.
Okay, thank you.
Right. Yes, Oxbert, come up.
Yeah, so I wanted to find, I was going through some questions. There's an effective interest rate is, let's say they give you an effective interest rate, and they'll say effective interest rate is somewhere 10%. Then they'll say, but the impact of the issue cost is to increase the effective interest rate to a certain amount or to 17. How will you treat something like that?
There is no statement like that as per my judgment, though, but because they will tell you that the coupon rate on the loan note is, say, 15%, but then the impact of the loan makes the effective interest rate to be rather 18%. So
yes,
there will not be, yes. So it means whatever impact, the higher interest rate is always the effective interest rate. The higher interest rate is always the effective interest rate. So that is the deal. If they are giving the two interest rate, the one that is higher is always the effective. Then the one on the coupon is always the amount we pay every year.
Okay, thanks. But do you treat financial asset that is held for a long-term purpose but finally sold just as the way we treat assets. Do the same treatment.
Come again.
Financial assets that are held or carried for long-term purpose, but eventually they are sold.
Whatever. If they are sold, you de-recognize them in the books, so it doesn't change the accounting. As far as they were accounting for it, whatever they were accounting before the disposal is not an issue. So when we dispose it off eventually, we just de-recognize it in our books, so it doesn't change our recognition at the end of the day.
You do recognize it as per the way we do recognize IAS 16 assets, right?
Yes, we de-recognize assets. Okay. We de-recognize assets. Okay.
Yes, sir.
So the deal relating to that is, for instance, let me clarify something here. So let's say fair value through OCI. So it means that in other components of equity on the face of the statement of financial position, there may be some fair value gain relating to this particular asset you are talking about, this particular financial asset you want to sell. Okay, this particular financial asset that you want to sell. So as you sold it, let's say the day you are selling, you sold it for whatever amount. Let's say you sold it for 10,000, but then the fair value in your book, the carrying amount in your book was say 9,000. Now, certainly the balancing figure is profit or loss, and that will go to the P&L account at the end of the day. But then how about the gain that was in OCI relating to that asset? That gain that was in OCI could be reclassified as undistributable reserves. Could be reclassified as undistributable reserve, and that will be moved in the statement of changes in equity. So when you de-recognize the assets, whatever gain relating to that financial asset, which was in other components of equity, will also have to be reclassified from being just other reserves to undistributable reserves. And it could be sometimes added back or to the retained earnings, or just remain there still in the OCE, but it will be classified as undistributable reserves. To be classified as undistributable reserves. So that is the issue that I want to clarify there as well. Then, all right. Then there is a chart here coming up. Anita said, please, can you go through the issue about associate in consolidated financial statements? We said that investment in associate and joint venture arrangements are accounted for using what we call the equity accounting. The equity accounting. Now, the equity accounting simply states that the carrying amount of our investment in associate will be the initial cost. Okay. Then we add any profit or loss, post-acquisition profit or loss, our share of post-acquisition profit or loss. If it is a loss, you subtract. If it is profit, you add. Then during the year, if we receive any dividend from the associate, it reduces the carrying amount. Please note, if you are doing consolidated P&L, it is the share of profit or loss that goes to the P&L. If you are doing consolidated P&L, it is the share of profit that goes to the P&L. If you are doing consolidated statement of financial position, the share of profit will be going into group retained earnings. So this will either go to the P&L if you are doing consolidated P&L, or group retained earnings if you are doing consolidated statement of financial position. The dividend received does not go to the P&L. The dividend received does not go to the P&L. So if in the question we are told that the dividend received has been included in their P&L, then we have to go remove it and rather add the profit, share of profit for the year from the associates. Then certainly if there is any impairment in our investment in the associate, it will be brought. So impairment in investment in associate will be brought. And impairment reduces our, not impairment in goodwill. This is impairment in investment in associate. It will be brought, then we'll deduct it from the figure as well in that particular case. Then if there is any intragroup trading, between the parent and then the associate, and there is still some of the goods in stock, then provision for unrealized profit will come. But here we will take only the parent's share of that. That's the difference between how PUP works here and in subsidiary. So if the provision for realized profit is 1,000 and we own 30% of the associate, we will take 30% of the 1,000. That is what we are going to be less in here. That will give us the carrying amount. This is what goes to the statement of financial position. So you do this equity accounting if there is an investment in associate and you are doing statement of financial position. But then if you are doing just P&L, then you are interested in share of profit or loss. And then if there is any PUP, that will be added also to cost of sales. If the parent is the one selling to the associate, if parent is the one selling to the associate. So if you asked about investment in associate, that is how it is treated in that case. And that is a question from Anita there. Let me know if that makes sense for you about the investment in associate. Yes, yeah, Jima.
Yes, Nhyira.
Yeah.
Please, my question on the financial asset. The
Uh-huh.
situation whereby the financial asset is for a long term, all things being equal, you're supposed to treat it as a the OCI. So where the question is silent as to whether to treat it as a P&L or OCI, do you do the default, or based on the long term of the investment, you choose the OCI?
It depends, because if the question is quiet like that, whatever treatment you go in for, the examiner will still mark you right. Whatever treatment you go in for, the examiner will mark you right. Whether you go, because of the long-term nature, we expect that it should be treated in the P&L. So whatever, if the question is quiet, whatever approach you go in for, the examiner will mark you right. So what is best will be dealing with the issue about which one will be appropriate as per the accounting for the entity. So since the long-term thing is there, you may go in for the OCI. Yes, but then you can still do P&L and it will still be marked right in either case, because sometimes it can be for long-term, but the entity will still choose to recognize it in P&L.
Okay.
To recognize it in the P&L.
All right, thanks.
Okay. Yes, Anita.
Okay, thank you. Please, I want to
sister, we
know
network in your cry. We network in your network is doing something.
Okay, stop.
I can't hear you.
Yes, question. I've realized most of the time
They
will say that.
Anita, relax. I can't hear you. Your voice is breaking up. I don't know.
Then I'll type. I'll try to type.
Okay, type and let's see.
Yes,
Because your voice is breaking up there. So see if you can type, and then let's see if we can pick you up from there in that question. Yes, James.
So my question is the follow up with the husband issue about de-recognizing a financial asset. If you can throw more light, it's like, I'm not getting, let's say the proceed, you are redeeming it at the proceed. Let's say that it was when it was issued. It was, let's
Relax. What you are saying is different from what Oxbeth said. You are saying financial assets, but you are talking about issue and redeeming. We don't issue financial assets. We don't redeem financial assets. So where are you?
So, I'm talking about financial assets when convertible loan. Hello. Where you have to,
yes,
you know, where you have to redeem it at maturity date.
Yes.
I want you to throw more light on that one for me. It's like I'm not getting, because the proceed, when we did the question in class, It's like we debited the cash with the proceed, and then
Relax. Like what you are saying is different from what you are saying two things which are opposite to each other. You
Okay,
don't
sir.
receive cash on redemption. You pay money for liabilities. You receive cash for assets. So are you talking about financial assets or you're talking about financial liabilities? Because if you're talking about financial assets and you're talking about paying cash, redeeming, we don't pay cash in financial assets. We receive money. So, like, which side of the aisle
My own
are you?
my own is a convertible loan. When we issue a convertible loan,
Uh-huh.
and when we issue a convertible loan, that is how do we redeem it?
If you issue a convertible loan and it is time for redemption and people are redeeming, you credit your cash book, you pay them out, and then you debit your loan notes by derecognizing the loan notes. That is all. Now, because it's convertible loan notes at initial recognition, you recognize an equity instrument. So that equity instrument will be reclassified as undistributable reserves. So that is convertible loan notes. They have taken their money, you pay them. So you credit cash, you debit the loan notes to derecognize it.
This is the proceed of the loan.
The amount at which they are supposed to redeem the loan at. Whatever amount they are supposed to redeem the loan at is what you pay them. If it is the nominal value or it is redeemed at a premium, whatever amount they are supposed to get is what you give them for the period under review. And that will be the amount that will be outstanding if you do the amortized cost schedule up to the closing of the year. So that amount that will be outstanding is that amount that will be at the end of the year in your statement of financial position. So you debit that figure, cancel it out, then you credit your cash book.
But not the proceed at the initial stage, initial recognition.
No. You are dealing with redemption. So it's not a proceed at the initial stage because the loan can be issued at a discount and redeem at a premium. So it is what is outstanding at the end of the year that you pay, not what you received at the initial stages, not all the time. If it was issued at nominal value and redeem at nominal value, then definitely on the date of redemption, you will pay them the same money you got. But if it was issued at a discount and you are redeeming at a premium, then you're going to pay them more than they gave you because of the interest that has built up over the years. And that will be because of the amortized cost schedule you will prepare. That will give you the carrying amount of the loan notes at the end of the year.
Okay. Thank you, sir.
Right. Please, what does it mean when the question asks what treatment of a transaction, especially in the, what does it mean when the question asks about treatment of a transaction, especially in the case of the IAS? I don't get the context of your question, Anita, though, but if the question say what is the treatment of something or explain the treatment of something, yeah, you explain it the way it has to be. It has to be done. So whatever, let's say a question is given to you, then the examiner says, explain how the following is supposed to be treated. Yeah, you apply whatever accounting standard that you see in the question. Then you either write some small English, do the calculation where you have to do calculation, then you extract the financial statements. I don't know if that is the context of the question you are asking, though, but if they said when the question asks about treatment of a transaction, he said treatment of a transaction. So you read the footnotes. You read a question, and then however it is supposed to be treated, then you treat it in the books in that case. Let me know if that is the context of the question, because I mean your typing, I think, has something missing there in that regard. Then I got this note from the journal entry. Is the journal entry necessary? No, you don't do journal entry until you are asked to do that. Debit and credit thing, you don't do it until you are asked to do it. You don't do it. If the examiner says, what is the journal entry? Then you say debit or credit. But if he says, what is the accounting treatment? Then definitely we are not just talking about journal entry. We may have to extract the financial statements, or you will say, this is recognized in the financial statement as an income and recognized on the face of the statement of financial position as a non-current asset. That's better than just saying debit this, credit this. So it depends on the context of the question. If they say, what is the journal entry, then you pass it. But if the question says, what is the treatment, you don't just say debit or credit. You may have to tell the examiner that, okay, you recognize this in the P&L account under income. Yeah, even though if you do debit and credit is correct, technically that is not the only thing that we want to see or the examiner would want you to see in that regard. So I got this note also coming up from Angelina. I don't know if she's on the call. Let me look at it. And this is, I think she sent it on WhatsApp. It has been discovered that the previous financial controller of Dugan engaged in fraudulent financial reporting. Currently, 2.5 million of trade receivable has been deemed to not exist and requires to be written off, of which 0.9 relates to.
Nhyira, I'm here, but my network is very bad. I'm really struggling.
Oh, okay. So with 1.6 million relating to the earlier years. So the total amount is 2.5 fraud. So what is going to be happening is that the 2.5 will be removed from the trade receivables. Okay. So in the trade receivables, on the face of the statement of financial position, you bring the figure as per the trial balance, then you subtract the 2.5 from it because it's no longer there. That's the first thing you do because it's no longer there. So you're going to subtract the 2.5 from the trade receivables. Then number two, the 2.5 is split into two. There is last year, prior year, and then there is current year. The prior year from the scenario here is 0.9 relates to the current year. And then 1.6 is earlier period. So 1.6 is last year, 0.9 is this year. So what is going to be happening is that the one that relates to the prior year, the 1.6, you will subtract it from the retained earnings because it means the profit for the company has been overstated. So you subtract this from retained earnings. So when you go to the statement of changes in equity, this will be prior period error. And you deduct it from the retained earnings, the 1.6 million, the one that relates to the last year. Then the one that relates to the current year, it will be expense in the P&L accounts. And that may be under admin expenses in the P&L accounts. So that is the treatment for that note. If there is a prior period error, and that is as per IAS 8, accounting policies, changes in accounting estimates and errors. So the one that relates to last year will be deducted from the retained earnings, and then the one that relates to current year will be taken to the P&L accounts as part of administrative expenses, as part of admin expenses. Then the second footnote is on October 2017, Dugan Co. issued 1.5 million shares at full market price of this. The proceeds were credited to suspense accounts. Now, they are not supposed to put the proceeds into the suspense accounts. So we have to remove the proceeds from the suspense accounts. So 1.5 million shares by 2.2. So 2.2 by 1.5, that's going to be 3.3. It means I'm assuming 3.3 is in the suspense accounts. So that 3.3, which is the issue of the loan notes, must be, issue of shares, must be splitted into share capital and then share premium. Again, I'm assuming that the nominal value of the shares is $1. If the nominal value of the share is $1, then $1 times 1.5, which is going to be 1.5 million, will be added to the share capital. Then the 1.2 times the 1.5 will be going into share premium, being the profit on the issue coming in there, and that will be $1.8 million. And that will go to share premium. That will go to share premium because the issue was $2.2. Okay, so $1 goes to share capital, then the profits, $1.2, go to the share premium. So the issue of the shares, the 1.5 million, which is in suspense account, is not supposed to be in suspense account. So we remove it from the suspense account and come and add it to the share capital and share premium. And if we are supposed to prepare statement of changes in equity, then this will be occurring in the statement of changes in equity for the company for the period under review. So, Angelina, that is the issue about the 2 footnotes you sent. The VI, like I said, is a prior period error. So the 1.6, which is last year, would be deducted from retained earnings. Then the 0.9, which is this year, will be added to general expenses in the current year financial statement. Then the issue of shares, you split it between share capital and share premium. The nominal value will go to the share capital. Then the profit, the excess, will go to the share premium. The excess will go to the share premium. So that is the issue about that one also.
Okay, thank you very much.
All right. Yes, Oxbet.
Please, deferred development expenditure added to asset, how do you treat it?
What?
In ratios, if deferred expenditure, deferred development expenditure is added to assets, how do you treat it in ratios?
It depends. If it was not there last year, then this year is not supposed to be there. So it means currently when we are calculating capital employed, that may not be included, so that we will enhance comparison of the ratios that we are looking at. So if it wasn't last year and it was just this year, then it will not be included in calculating getting the capital employed for the current year and the review, because it wasn't last year. It wasn't there last year. So when that happens, it will make the assets this year more than last year, and that will affect our ratio calculation. So since it wasn't there last year, we may not include it in determining our capital employed for the current year. That is the treatment there about the expenditure that is being added to the assets. That's the treatment. Sometimes the question will tell you how it is supposed to be impacted, but if the question is quiet, then if it is not if it is in both years, you treat them the way it is. But if it was not in last year, it was just something done this year, and you don't include it. And that way you will have to calculate 2 ratios to enhance a better interpretation. So you calculate 1 ratio, including the effect of the development cost, and then excluding the effect of the development cost. And that is going to enhance the way you analyze the ratios, so that you will say that excluding, this was the ratio, including, this is the impact. Does that make sense?
Yeah. So if you make a mistake and include them when you are not supposed to include, that means you are wrong, right?
Yes, because like I said, it's not last year, it's just this year. So you just have to focus on this year. So you remove it. You remove it there. But sometimes if you include it and your analysis is quality, maybe the examiner could overlook it. But it's supposed to be excluded since it is not available last year, or it wasn't available last year.
Okay, thanks. Please, what of profit from sale of division?
Profit from sale of
division.
Yeah. Now that is a different beast altogether, because if we are selling a division during the year, then the impact of the division must be removed from the financial statement for the year. So their revenue must be removed from our revenue. Their cost of sales must be removed. So we have to redraft the financial statement. You have to redraft the financial statement. So you don't just deal with the profits of the division. You have to redraft. Now that will be done if we are giving the division's information. That is the revenue, cost of sales from the division. If we are giving the data for the division that was disposed of, then it has to be subtracted from the main figure there. And so we would have to redraft the financial statement of the company, so that we will now calculate new ratio based on the redraft financial statement, excluding the impact of the division. Excluding the impact of the division. So that is the issue about that also.
Oh, thanks.
All right. Any other questions? You put it in the chat for me if you're not ready to talk, or you can raise your hand and I'll bring you up. I'm seeing some. Let's see. Please say practical example on financial liability and assets. I don't know what you mean by practical example because I'm not solving questions here though. So I don't know what you mean by practical example. Please say explain measurement basis and ethics. Hey, ethics there, maybe. Let me talk about measurement basis. So measurement basis simply has to do with how an entity is able to, how do we call it? How an entity is able to carry the process of determining the amount at which an item will be carried in the financial statement. That is what we mean by measurement basis. The process of determining the amount at which an item will be carried in the financial statement. I think this question is from Augustine. I don't know if it's even on the call. Let me check if it's not on the call, then I could go to something else. Okay. I'll go to something else. If he comes, I'll go back. Please, can you touch on what? Value-added statements? Value-added statements. Let me see. There is a slide on that. Let me see if I can bring it up. Now, value-added statements, it's one of the statements available in the financial statement. There was a question about this we solved last semester. So you can check the last semester, November 2022. There is a video under November 2022 value-added statement, and we solved a question about it last semester. So if you want to watch that, you are interested in that, you can check last semester's video, and you'll be able to watch that up. Let me just airdrop my slide here. Oh, come on. I don't want this. I want a PDF file. I want to see if I can bring up the slide. It's not picking up. It's just save to the phone. Give me a moment. I'm airdropping the slide and I will just explain it to you and then show you the question as well. Keep both. Oh, God. Okay. Yeah, so I can now airdrop. Let's open in file on my iPad. Yeah, so like I said, there is a video on this on the portal under November 2021 Zoom sessions. You can check it and watch it in that particular case. And that is the issue there. But then the value-added statement is simply a statement that is prepared to look at the value that has been created by the company and also see how that value that has been created will be distributed among the various stakeholders of the organization, like employees, shareholders, creditors, management of the company, the value that has been actually added for the period. And so if you watch that video, we solve this question. I'm not going to go through it, but we solve a question and then we identify the major stakeholders of value added statements. Like I said on the portal, you can watch the video on this and we solve this question. And if it is something you are interested in, because I wouldn't have time to solve the question and we want to look at the issue about the value that has been created by the entity, and then we will distribute the value that has been created among the bondholders, employees, governments through taxes at the end of the day as well. Then payables, how much we pay to them in that. So if you ask about value added statement, you can watch the full video on this. It's not a long video. We did it last semester. You can watch it on the portal in that case. Let me see. George is still not on the call. Let me see if I can have another question from the slide here. Please, does it mean that, no? Is it possible to ask question on current or emerging issues in FR? And that no, there's nothing like current or emerging issue in FR. So please stay where you are. Just where you are, stay there. There's nothing like current issues in FR. You just have to focus on the things you have to focus on. Current issues, it's not available there. So that's for Joseph. So there's no current issues here. Okay, then I'm seeing another chat coming in on YouTube. Vena said, please, can you explain the disposal of subsidiary when parent does not own 100% of the subsidiary? I don't understand the question. Can you explain the disposal of the subsidiary when the parent does not own 100% of the subsidiary? I don't understand your question. So maybe give me clarification. If they don't own 100%, then they own how many percent? Disposal of subsidiary, I explained the pro forma for calculation of the profit or loss. This is it. You bring in the fair value of the proceeds that you got. Any amount that has been retained is added. You bring in the NCI at the date of disposal. Then you subtract goodwill at the date of the disposal as well. Then you subtract the net asset at the date of the disposal. The difference between that gives you the profit or loss on the disposal. That gives you the profit or loss on the disposal. So I don't know the context of your question, Vena, Okma, or Akon, sorry. But that is how we calculate the profit or loss on the disposal. Sorry, that's how we calculate the profit or loss on the disposal. So that's just about it as well. Like I said, Augustine is not still on the call, so I'm gonna skip this for now. When it comes, I'll talk about that. Yes, Oxbet.
Sir, it's me. Oh,
Okay, yes.
Yeah, sure.
Yes, James.
sir, please, I want, if you can, throw more light on the value-added tax.
What is value-added tax?
Hello, sir, under VAT, the calculation.
The issue about value-added tax is calculated as bringing in the value of the product. So you bring in the value of the product. You bring in your national health insurance levy. That's 2.5%. Now that's multiplied by the value of the product. So times that figure there. You bring in the get fund, also 2.5% of the same figure. Then now we have the COVID-19 recovery levy, which is 1% of the same value. Then you get a gross amount exclusive of VAT. Then you bring in the VAT amount, which is going to be 12.5% of that gross amount. And that gives you the VAT invoice or the amount inclusive of VAT. Now, this is if the entity is applying the standard system. But then if the entity is using the flat rate system, then the way we go about that is, did I write dollar here? Okay, no currency, that's good. You bring in the value of the goods. Then you bring in the COVID-19 recovery levy because they are bringing in 1% of the COVID levy. That'll be 1%. Of the value of the product. Then you bring in the VAT here. That's going to be 3% also of the value of the product. And that'll be the VAT invoice. So under the flat rate system, the rate now is 4%, 3% for the VAT itself, then the 1% for the recovery levy. So if you ask about the calculation of VAT, that is a standard rate system, and that is the flat rate system as well.
When you calculate, are you deducting it or you are leaving it like that?
I don't understand.
When you calculate, like from the value, like coffee, 1 point this thing from the value, the figure, are you
adding? If we are subtracting, I'll put it in brackets. So everything is being added to get a gross amount, right? Then the VAT is done on it. Everything is added to get a gross amount, then you bring in the VAT. Everything is being added. You won't deduct anything.
Nhyira. Hello,
Yes.
Nhyira.
Yes.
About this VAT issue, would I think that there was some issue concerned about the calculation, because we went for some with the Ministry of Finance for the calculation. Formally, you know that we calculate all based on the goods, but not nowadays. Let's take this 3%. They will calculate the 3% on the value of the goods. Then you add it before you calculate the COVID-19.
Yeah. What I'm doing here is as per the syllabus structure, like what we are supposed to do for the exams. In practice, the computation is different and the structure is different as per the directive of the Minister of Finance. So what we are doing here is not what is done by GRA or Ministry of Finance directive. This is as per the exam structure and what we need to do.
Okay, thank you.
Okay. Okay, so that is it about the VAT. I hope that makes sense for you. That's the calculation on the flat rate system and then the standard rate system also there. Yes, Oxbet?
Yeah, please. Does unwinding of deferred consideration affect net asset at acquisition?
Hey. You see this question, assuming you are closer to me, I have to whip your buttocks before I answer you. Yes.
Yes, I'm asking the question because I realized that this thing, provisions, unwinding of provisions is charged at net asset at acquisition.
Relax, take it easy.
In terms of
relax, take it easy.
All right.
Fair value of consideration transferred. When it includes deferred consideration, unwinding is for the parent entity. That goes to group retained earnings if we are dealing with consolidated statement of financial position. But it will be added to finance costs if we are doing P&L. So consideration unwinding is for the parent. But if the subsidiary, as part of the fair value adjustment, the examiner said there is an environmental cost they are supposed to provide for that they had not provided for, then that one, the unwinding of that environmental cost as per IAS 37, because it relates to the subsidiary, it will be coming at the end of the year. Does that make sense? That's the distinction.
Yeah. It makes sense. Because it is unwinding, I was a bit skeptical about it.
No. If it's about consideration, deferred consideration, everything stays in the.
But it will go to group retained earnings, right?
What?
The deferred consideration when you unwind it.
Yeah, the unwinding deferred consideration goes to group retained earnings if you are preparing consolidated statement of financial position. But it will come to finance cost. You add it to finance cost if you are preparing the consolidated profit or loss account. If you are preparing the consolidated profit or loss account. So that's the distinction for the treatment.
Okay. But is it possible that acquisition date will be the same as bottom date?
For what? For what?
Huh?
For what?
So like acquisition date being the same as reporting date.
It's possible that way. It's possible. That means that we are acquiring them at the end of the year, like at the very end of the year. So in that case, there will not be any post-acquisition profit or loss situation. And so you just added it. But in P&L, nothing will happen because you cannot take their revenue, you cannot take their cost of sales. But in position, you can consolidate their assets because they are now your own at the end of the day. Because from the date of acquisition, with their assets belong to us, but their revenues, we can't take anything because you didn't or you were not there throughout the year. You were not there throughout the year. On YouTube, I'm seeing a question here. Yeah, Domnana Ekia Konedu said, good evening, sir. Sorry if I'm late, but my question is, how do we treat PUP if associate sells to parents? I think I've spoken about that. If an associate sells to parents, okay, if the associate is selling to the parents, and at the end of the year, the parents still has some of the inventories in stock, we have to calculate the provision for unrealized profits. When we calculate that provision for unrealized profits, we will take only the parents' ownership of the associate of that figure. I explained that earlier. I think you were not around, but that is the issue there in that regard. So yes, you calculate PUP, but then you will take the parent's share of ownership of the parent's ownership of the associate as a share of the PUP. And I'll say, and that will be the amount you're going to be deducting from any post-acquisition profit or loss of the associate before you take our share of ownership for the period under review. Before you take our share of ownership for the period under review. So whatever post-acquisition profit or loss from the associate that is given. So if we are giving profit from the associate for say 1,000, and they have sold to the parents, we will bring the parents' ownership of that PUP, whatever be the case. Let's say we calculate it's 100. That means the adjusted profit will now be, or it's 100. Then the adjusted profit will now be 900. So it is this 900 that we will do share of post-acquisition profit or loss that will go to group retained earnings. That will go to the group retained earnings, or will go to the P&L accounts if we are doing the P&L. So if a subsidiary sells to the parents and at the end of the year, the parent has some in stock, that is how we deal with the PUP. And that is from Nana Equia Konedu on YouTube. Let me see. Any other questions for me in my chat? Let's see if I can get other questions. Okay, then. Yes, Oxbert.
Yeah, so what are the situations that will result into a contract asset being recorded as a non-current asset? Because I've realized that mostly it is the current asset that it affects.
It's always a current asset because the contract is still being done and that money will be receivable in the next accounting year. So it's always going to be a current asset, almost always, unless otherwise we are finished with the contract, but then there is a condition standing that we have to wait for say 2 or 3 years or more than 12 months before we receive that money, then it will be under non-current. But as the contract is still ongoing, it will always be under current because we are supposed to receive that money at the end of the, or in the next 12 months, within the next 12 months. Then there is a scenario okay. Then there's a question coming up on IFRS 16 leases for me to share my thought on. So when it comes to IFRS 16, it is actually a standard that is replacing IAS 17 leases as well. Now, the case or the concern about IFRS 16 it simply has to do with the lessee accounting. That is where our focus is going to usually be at the end of the day. Now, the distinction here is that under IFRS 16, it is the lessor who classify the lease as a finance lease or an operating lease. It is the lessor who classifies the lease as a finance lease or an operating lease. Now, when we say a lessor and lessee, what the heck do we mean by that? So, for instance, let's say that we have an entity here, whatever, let's say Angel Limited, and then let's say whatever, Milan Limited. So let's say we have two companies. So let's say Milan Limited owns maybe a vehicle. Okay, they own a vehicle. Then they enter into an agreement where Milan Limited will transfer the vehicle to Angel Limited for them to use. Then Angel Limited, in return, will make what we call annual lease payments. Annual lease payments. Now, Milan, being the owner of the asset, is who we call the lessor. Angel Limited, who now is given the right to use the assets, is who we refer to as the lessee. Is who we refer to as the lessee. Is who we refer to as the lessee. So that is who a lessor is, the owner of the assets. Then the lessee is the one who is given the right to use the asset. Now, when it comes to the lessee, how does the lessee account for the issue? IFRS 16 gives two guidelines on how the lessee can recognize leases. We have the default treatment or the default approach for recognition of the lease. Then we have what we call the exceptional treatment as well. Now, let me talk to you about the exceptional, then we come to the default, because that is the la creme de la creme at the end of the day. The exceptional approach is where the asset is a low value asset. So if the entity deems the asset to be a low value asset, then they will treat the lease as an operating lease. In that case, they will treat it as a normal rental. So they will just write off any annual lease payment in the P&L accounts. They will write off any annual lease payment in the P&L accounts, period. Story ends there. If they deem the asset to be a low value asset. Now, this is as per the judgment of the entity in the question. It's as per the judgment of the entity in the question. Then they will do it. Or better still, maybe it's not a low value asset, or maybe the lease term is short. Okay? Maybe it's a short lease term. So if the lease term is short, maybe it's just a 1 year lease. I mean, it will be headache to recognize asset and recognize liability as well at the end of the day. So that is the exception approach, where the asset is of a low value or the lease term is short. Then the entity can use the exception approach and they can treat the lease as a normal rental. Nothing will be recognized in the statement of financial position. The normal lease rental is recognized in the P&L. If it is not paid at the end of the year, they will recognize it as part of current liability. But that is all. Story ends there. That is the exception approach that the entity can select to account for the leases. But the default approach, the traditional approach, is where the entity must recognize both right of use and then lease obligation. ROU and then lease obligation. So that is the default approach. So we recognize an asset and recognize also a liability at the same time. At the same time. So that leads us to the initial measurement. So under the initial measurement, or not measurement, initial recognition, simple, we will debit right of use assets or leased assets, depending on whatever choice of words that you want to use. And then you credit the, how do we call it? Lease obligation, LL, there. But then the figures may be different. the figures may be different. So for instance, the right of use can include the following. One, the present value of the minimum lease payment, how much you are paying on the lease. Then any directly attributable cost we incurred in arranging the lease. So any directly attributable cost incurred. Remember, as per IAS 16, the initial cost of an asset shall be the purchases cost and all other costs incurred in bringing the asset to its present use. So any directly attributable cost we incurred in arranging the lease will be capitalized, not expense, will be capitalized. So we may lease, we need a lawyer to read the contract, sign the contract, So any professional or legal fees we pay, that is what is coming here as directly attributable cost in that case. Now, if the asset we've leased required some installation, rarely though, but it has to be brought as well there. Then if during the year, what is going to be happening is that we are going to also do dismantling costs, then maybe we have to make provision for that. Dismantling costs. Usually these are the two we see. Usually. The present value of minimum lease payment and then directly attributable costs. But then if for some reason the lessor reimburses us, okay, so reimbursement from the lessor for any expenses we have incurred from the lessor, that will be brought here and reduce the directly attributable cost that we have paid. So that will be negated here in that particular case. Now, maybe the lessor doesn't want to take a lawyer, so you also take a lawyer. So he said, just take a lawyer and then let the lawyer arrange everything. So when you finish, you incur the cost of maybe $10,000. Then he said, okay, he will reimburse you with $3,000. So it means your directly attributable cost technically is $7,000. So that is why we will subtract that. Then we'll get the value. This value is the initial measurement for the right of use. And that is what we debit to the right of use. That's what we debit to the right of use. So when we say the right of use figure, that is what it could be. It could be the present value of minimum lease payment plus directly attributable cost less any reimbursement we receive from the lessor for our expenses. Then the lease liability also could have some components there. Definitely the present value of the minimum lease payments. That's going to be the first one. Any deposit we make will reduce our liability. Any deposit we make will reduce our liability in that particular case. So if there is any deposit, it's going to reduce our liability for the period under the initial measurement of the liability. It will reduce it for the period under review. Then again, this is also rarely though, but if it happens that based on the way the economy is going these days, there has to be any variation in the lease payment, which is pegged against price indexes or the inflation rate, then that may increase our liability, so it has to be added. Again, that is rare. Okay, that is rare. Then if it happens that there is penalty for cancellation and we think we may be canceling the contract, we may have to build it into the system. We calculate the present value of that and bring it into the system. Now, why? Because if you lease an asset for say 10 years, you are telling the lessor that, hey, listen, if you go to sleep, because the next 10 years, every year, I'll be giving you some money. So you're telling the lessor to sleep. Now, if after 5 years, you say you don't like again, you are leaving. Now, the lessor cannot rent the house or the facility in the next month. Sometimes it can take another 2 or 3 years. So for your punishment for canceling the lease, in the contract of the lease, it may be stated there that if you cancel before that time or you don't give a prior notice, 2-year prior notice before cancellation, then you will pay a penalty of this. And the entities feels, they are not likely to be in this building for the next 10 years, then they will build it into the system. So that could also be what we talk about there to get our initial measurement for the lease obligation. Okay? Initial measurement for the lease obligation. Yes?
So please, in this case, the penalty issue, is it that a subsequent measurement of the minimum lease payment that you readjust it, or how is it going to be in case of the penalty? Because you yourself, you don't even know whether that is likely to happen or not.
No, once you are not likely, based on your judgments, you will not be in the building for a long time. You put it there. You have to make provision for it because there is a present obligation. The contract means a present obligation, but you don't recognize it individually on your financial statement. You have to add it to your lease obligation and then account for it. If it happens that at the end of the lease, you don't undertake it, I mean, that is a savings to you at the end of the day, but you have provided for it in that regard.
Okay. All right. Thanks.
Okay, please, how did we calculate the present value of minimum lease payments? That one, the clue will be given to you. Maybe the question will say that every year, the annual lease payments every year is 10,000. And you are leasing the asset for 10 years. So we'll be giving the interest rate implicit in the lease. So interest rate implicit in the lease, whatever, let's say 15%. So you calculate, you get an annuity factor. You get an annuity factor of 15% for 10 years. Then you use it to multiply the 10,000. That is how you get the present value of the minimum lease payments. Let's see if I can get my annuity table and show you that. FM. Okay. My annuity table could be here. Yeah, this is the annuity table and this is the annuity formula. I think somebody asked before, what is the annuity formula? Not in today's class. So this is the annuity formula here. So you substitute the 10% into it to calculate the annuity factor, because in such questions, we are not giving the table. So to make it simple, the examiner will give you the annuity factor. Usually, he will give you the annuity factor. If he doesn't give you, then you have to calculate it using this formula. But if I'm reading 15% for 10 years, 15%, this is 15%, 10 years is 5.0919. So to get a present value of the minimum lease payments, it will be 5.019 times 10,000. And your answer is the present value of the minimum lease payment. So that's how you calculate the present value of the minimum lease payment. Is the annual lease, because you are paying the same amount of money over the period. That's why we use the annuity factor. But you can also do it 1 year for 10 years. That one needs to be long. In that case, you can use the present value formula. That one is easy. You can remember that. The annuity factor is like it's some way. It's also easy though, but this is it. 1 minus into bracket 1 plus r exponent negative n or divided by r. So Isaac, in the chart, that is what you need to understand there about that.
Nhyira.
So, yes.
Yeah. For this annuity, I think the formula that we give it was that was ordinary annuity, but if it was paid in advance for that one, you need to use annuity D to calculate.
Relax.
Yeah,
Take it easy. You said.
Yes. I said that the formula that you gave, that was where it is paid in arrears. For that one, you use ordinary annuity formula. But when they pay in advance for that one, you have to use annuity D.
At the beginning of the year.
Yes.
So, like I said, the issue about the calculation of this will always be given to you in the exam hall. You wouldn't have to calculate that usually at the end of the day. So, because these formulas are adjustable and subject to a lot of judgment. So whatever calculation that it is, the examiner will give it to you. So sometimes you don't have to bother yourself too much on it. But what you're saying is true. We could have the payment made at the end or at the beginning. So that's how we get our right of use and then our lease obligation. So that is the initial measurement. Now on subsequent measurements, the question we ask ourselves is, how do we deal with the right of use? How do we deal with the lease obligation? Simple. The right of use is depreciated, and then the lease obligation is carried at amortized cost. Okay, so how do we deal with that? Very simple. We depreciate the right of use. So depreciate the right of use over the I, lease term, or II over the economic useful life of the assets, of the leased assets. You use the second one if there will be title transfer at the end of the lease term. Okay, there will be ownership transfer at the end of the lease term. But if the question is quiet, then we just use the lease term. Okay, so you can depreciate it either using the lease term or the economic useful life of the lease asset. But you use the economic useful life of the lease asset if there will be title transfer at the end of the lease term. If there will be title transfer at the end of the lease term. If there will be title transfer at the end of the lease term. Or if the entity is leasing the assets for a greater percentage or the greater portion of the economic life of the assets. So for instance, if the asset has an economic life of 20 years and our lease term is about whatever, 20 years, or maybe our lease term is like 18 years. I mean, we are using the asset for its whole life. And so usually we will go with the lease term at the end of the day. The assurance is, will there be title transfer at the end of the lease term? If yes, then we use the economic useful life of the asset. So that is how you deal with the right of use, and then you depreciate it over the useful life of the asset. Now, that depreciation may be done if we are accounting for the lease asset as something we are using in our day-to-day running, IAS 16. But sometimes a company can lease an asset, then they will sublet it. That way, it's an investment property. So they will account for it using what? IAS 40. That way, they will account for it using IAS 40, and so they will carry it at fair value. But if you remember, even if we are carrying the asset at investment property, sometimes the cost model can still be used where depreciation can be charged. So it depends on the subsequent measurement what the lease asset is being used for. If the entity leases the asset to sublet it, then usually on the subsequent measurement, we will carry it at fair value as per IAS 40, the default treatment for fair value adjustment, the default treatment for fair investment in investment property. So that is the right of use, and that's how we get our carrying amount of the right of use. Now, the lease obligation will be carried at amortized cost. So you have to prepare the amortized cost schedule for the period under review, and the amortized cost schedule preparation will be dependent on how the entity is making the payments. Payments can be made at the beginning of the year in advance, or can be made at the end of the year, and that is in arrears. It could be made at the beginning of the year or at the end of the year. So in advance or in arrears. Now, if the payment is made in advance, we will prepare the amortized cost schedule for the year that we are preparing the financial statements. So we prepare the amortized cost schedule for the reporting date that we are preparing the financial statements. But then if it is the payment is made in arrears, we prepare the amortized cost schedule for next period as well, even though we don't need it. So we prepare it for up to the current year, the reporting date, and then for the next period, meaning that we will do for 2 periods here, but we'll do for only 1 period up to the reporting date. The reason why I'm not using 2 periods and 1 period is that sometimes we can lease an asset 2 years ago, and the examiner is asking you to calculate the carrying amount of the lease obligation. So if payment is made in advance, you will do your workings up to the reporting date that we are being asked to prepare the financial statement. But if payment is made in arrears, then you will do your amortized cost schedule up to the year ended that we are preparing the financial statement and the following year. Now, payments can also be made midway through the year, semi-annually. So if payment is made in advance, then what is going to be happening is that we'll bring our year, we'll bring our balance brought forward, we'll bring the payment because we have to make the payment at the beginning. So lease payment will come. Then we'll get a capital balance. Then we'll bring in the interest. Then we'll bring the balance brought down. That's the closing balance. So this is it about that. Now, so you're going to be bringing in whatever reporting date we have, the opening balance, the initial recognition you had. The lease payment is the annual lease you pay every year. You subtract that, and that gives you the capital balance. The interest rate implicit on the lease will be given to you. You calculate that, and that gives you the closing balance. So this is if payment is made in advance or at the beginning of the year. Now, this closing balance must be split into current liability and non-current liability on the face of the statement of financial position. When payment is made in advance, the current liability is going to be the annual lease payments. It's going to be the annual lease payments. Then the non-current liability is going to be the balancing figure, which is the closing balance. The closing balance, the balance brought down, minus the annual lease payment. So if payment is made at the beginning of the year, that's how you deal with the issue relating to that. If payment is made at the beginning of the year, that's how you deal with the issue. You do the schedule up to the reporting date. Then that balance brought down is splitted between current and non-current. The current is the annual lease payment. The non-current is going to be the balancing figure for the period under review. Then if we are making the payment in arrears, that one, we bring our period up. We bring in our period up. Then what is going to be happening is that we get our amounts relating to the balance brought forward. We bring in the interest. Then we get the lease payment because we are making payment at the end of the year. And we bring the balance brought down. Then we bring the balance brought down. So, like I said, when payments are made in arrears, you do the workings for 2 periods, up to the date of the reporting and the next accounting year. Up to the date of the reporting and the next accounting year. So what do you have? So let's say our date of reporting is the first year. You bring in the opening balance, calculate the interest on it. You less your lease payment and you get a closing balance. Now, this closing balance has to be splitted between current and non-current. But here, you don't just get up and split. So you have to do for the next accounting year. You do for the next accounting year. And the closing balance in the year 1 will come to the opening balance for year 2. You calculate your interest on that. You make your lease payments. And then you get the closing balance. So that closing balance for the next accounting year or the following accounting year is the non-current liability. Then the difference between the first and the second year is the current liability. So that is how you do the split for leases. Please, in IFRS 9, financial instruments, when you're doing amortized cost schedule, you don't split between current and non-current. It is only in IFRS 16 leases that we do the split. Note that it is the interest charge that goes to the P&L account. So whether you are in advance or in arrears, it is the interest charge that goes to the P&L. The lease payment does not go anywhere in our financial statements apart from being subtracted to arrive at the closing balance. So that is what we do when payments are made or when determining the carrying amount of the lease. So that is also the issue we need to understand about leases in that case when we are supposed to deal with them. Yes, Josephine.
Sure.
Yes.
Please, there is this note. I want to read it. Then you help me digest into it. Okay. It says
Okay.
Nhyira was incorporated some 5 years ago with a full paid up capital of no par value issued at 25 Ghana pesos. No further issue of shares was made up to 30th July 2018. On 1st August 2018, Nhyira made a fully subscribed rights issue of 64 million equity shares of no par value issued at 35 Ghana pesos each.
Mm-hmm.
And then in the trial balance, they've given you equity share of 25 Ghana pesos. The total amount is 78,400.
Relax. What is the requirement? Well, what are you doing?
I'm preparing income statement of changes in equity, and then statement of financial position.
Right. So the nominal value of the shares is 25 pesos. So
Yes.
this 35 pesos must be splitted into two. A portion must go to share capital. A portion must go to share premium. So 25 pesos times the 64 million, the shares that were issued, is what will go to the share capital. Then the balancing figure will be 10 pesos, I guess, times 64 million will go to the share premium. So that's how you do the split. And that will be added to the opening balances in your statement of changes in equity so that you get your closing balances that will go to the statement of financial position.
Sure.
Yeah.
Beginning, I thought I have to divide to get the number of shares because this is in value 64 million Ghana cedi.
Oh, relax. Not 64 million shares.
Yeah, they said fully subscribed right issue of 64 million equity shares. Oh, okay, this is shares. Okay.
Okay.
I thought it was value.
So that is the
Okay.
treatment there. All right. A question on YouTube. Mumuni said, good evening, sir. Please, can you who is AJ trying to join my meeting? No. AJ. Free. Ajarana. Mumuni said, good evening, Nhyira. Please, can you throw more light on when subsidiary sells to parent and there are some remaining at the end of the year and vice versa? I think okay. So when a subsidiary sells to the parents and there are still some of the goods in stock, we have to calculate provision for unrealized profits. And that provision for unrealized profits, we have to subtract it from the subsidiary's profit for the year. You have to subtract it from the subsidiary's profit for the year. Okay? We have to subtract it from the subsidiary's profit for the year. But if you are doing consolidated P&L, it must be added to cost of sales because double entry for provision for realized profit is to debit cost of sales if you're in P&L, or you debit group retained earnings if the parent is the one selling and you are preparing statement of financial position, or you debit the profit for the year of the subsidiary. If the subsidiary is the one selling, then certainly you credit inventory. you credit inventory. So that is the general treatment for provision for unrealized profit, Momoni on YouTube. When we say debit cost of sales, we mean add it. For those of you who don't understand double entry, when we say debit group retained earnings, we mean subtract it. When we say debit the profit for the year of the subsidiary, we say subtract it. When we say credit inventory, it means deduct it from inventory or subtract it from inventory. So when it comes to provision for unrealized profits, generally, these are the things that we need to understand there. And that is what we do there. So that is from Momoni. So if there is trading between parent and sub or sub and parent, and there is provision for unrealized profit, Momoni, Imoran, that is how we deal with that on YouTube there. Okay.
Nhyira,
Yes.
Nhyira, please, will you just go back to the list and complete sale with lease and sale back, sale and lease back option.
Okay, let me see. You say, can you show what? Now, if there is sale and lease back, the way it is accounted for depends on whether it meets the recognition criteria for revenue as per IFRS 15, revenue from contract with customers. So the question we ask ourselves is, has performance obligation been satisfied? So according to IFRS 15, we recognize revenue if performance obligation is satisfied. So if there is sale and lease back, we ask the question. If we ask the question, we could get two answers. Yes, performance obligation is satisfied. No, performance obligation is not satisfied. If yes, performance obligation is satisfied, that means the sale of the asset is actually a sale. So it means the transaction is a sale. If the transaction is a sale, what happens is that the lessee is going to de-recognize the asset. So the lessee de-recognize the asset. The lessee de-recognize the asset, but will instead recognize right of use, being the lease. Then we'll also recognize lease liability. We'll also recognize lease liability. So yes, performance obligation has been satisfied. It means the transaction is a sale. We have actually sold the asset. So in that case, we de-recognize the asset, then we can recognize right of use. Then from there, we will apply whatever IFRS 16 lessee accounting, and then we go away in that case. So if it is a sale, that is what we do. The lessor, on the other hand, because it is a sale, the lessor will recognize the asset in his book, and then certainly will apply lessor accounting for leasing the assets to the lessee. So if the performance obligation is satisfied, it is a transaction or it is a sale, then that is good. Then that is good in that particular case. But this is the deal. If it is a sale and we are leasing it back, that means technically there is a portion of the asset we have retained. So one thing, the third thing the lessee does is that the lessee will recognize gain or loss on the actual amount transferred. Will recognize gain or loss on the rights that has been transferred. On the right that has been transferred. Then the way you recognize right of use also here will be the proportion of the carrying amount retained. The proportion of the carrying amount retained. The proportion of the carrying amount retained. That is how you recognize the right of use, because it's a sale and you are leasing it back. So yes, you do recognize the asset, you recognize right of use, but the right of use here is not present value of minimum lease payments. Now, the right of use you recognize here will be the proportion of the carrying amount that you have retained based on the lease that you have received. Now, the way you work that out is that you calculate the present value of the minimum lease payments. And that's divided by the fair value of the assets will give you the percentage of the assets that you have retained. Okay? Will give you the percentage of the assets that you have retained. So your right of use will be the carrying amount times the percentage of the assets retained you calculated. That's the deal here. So if it is right of use, performance obligation is satisfied. Sorry, if it is a sale, performance obligation has been satisfied. The right of use you recognize here is based on the percentage of the fair value that you have retained. The percentage of the fair value you have retained. And that is going to be the percentage retained times your carrying value. That is going to be your right of use. So to get the percentage of the asset that you have retained, it is the present value of the minimum lease payment divided by the fair value of the asset. And so if you, once you get a percentage of the asset you have retained, then you will get the right transferred. And that right transferred is what you will calculate gain or loss on at the end of the day. That is what you will calculate a gain or loss on at the end of the day. So that is the issue about that particular one when we talk about the performance obligation being satisfied. Now, if the performance obligation is not satisfied, the answer is no, then the transaction is not a sale, but it's a financial arrangement. It is a financial arrangement, and the asset has been used as a collateral facility. It is a financial arrangement, and the asset is being used as a collateral facility. It's a financial arrangement, and the asset is being used as a collateral facility. In that case, what is going to happen is that the lessee continues to recognize his assets because it's not a sale, but the lessee must recognize a financial liability and then account for it as per IFRS 9 using the amortized cost schedule. The lessor, on the other hand, will recognize financial assets because they have lent money to us. Then from there, we'll apply IFRS 9 financial asset through P&L or through OCI. Because it is not a sale, so we don't recognize an asset. We don't recognize any lease obligation here. Instead, we recognize a financial liability because it is a loan that the lessor has given us, and we use the asset as a collateral facility because the performance obligation is not satisfied. Because the performance obligation is not satisfied. But then under the sale and leaseback arrangement, two things can happen. The lessor can do two things. Either the lessor will give us a proceed, so we will get a proceed greater than the fair value of the asset, or proceeds less than the fair value of the asset. Stay with me carefully. If the proceeds is greater than the fair value of the asset, the difference is called additional financing or additional finance, and that is added to the lease liability. What does that mean? It means that the asset you claim you are selling, the fair value of the asset is, say, $10,000. But then the lessor gave you a cash of $15,000. Now, the lessor is not Father Christmas to dash you 5,000 like that. So that extra 5,000 the lessor is giving you is an additional loan he is giving you. That is why we say if the proceeds is greater than the fair value of the assets, the difference is treated as what? Additional finance, and it is added to the lease liability. But if the lessor gives you less than the fair value of the assets, the difference is treated as lease prepayments. It means you have paid some of the lease in advance. So here, the fair value of the asset is, let's say, $15,000, but then the money that they gave you was $8,000. Why? Indeed, the $7,000 that is left will be accounted for as lease prepayments, And that is the concept about the sale and lease back. That is a concept about the sale and lease back. Now, I solved a question about this. I think the video has been added to the April 2020 Zoom session, and you can check, and you can just skip the video up to the point where the question was solved so that you can watch how this is done if you are interested in that, for those of you who are asking that question. So that is basically the idea about the sale and lease back as well. Then my final chart there is Isaac said, please, can you throw more light on acquisition through issue of loan notes? If there is issue of loan notes, it's loan notes. So the fair value of consideration transferred, you will bring in the loan notes that they have issued. But what happens is that on subsequent measurements, the loan notes must be carried, so we have to pay interest. So when we are preparing consolidated statement of profit or loss, the interest on the loan note that was issued will go to finance cost. Okay, will be added to finance cost. That's subsequent measurement. But if you are preparing consolidated statement of financial position, then it will be subtracted from group retained earnings or consolidated retained earnings. Then if we go to the statement of financial position, that loan note will be there under non-current liability. That loan note will be there under non-current liability. So if you ask for issue of loan notes on acquisition, that is how it is treated. And that is from Isaac there in that case. Okay, so I think these are the questions I have with me here. And so that is the issue there. I'm going to conclude around here. It's like the class was FR and CR people. You're just taking over the class like that, by heart, like that. But it's fine. We're hoping that you are going to do well. This is just notes that last semester, November 2021, best student in financial reporting is from here. All right. Kofi Christ, they'll be going for graduation 25th of April. And the best student for FR was coming from here. So please, as you go in there, work hard and let's make some name and let's make some money at the end of the day. So make sure you do your work well. Okay? Make sure you do your work well. We are doing all these things because we want you to have more opportunity. We want you to have more understanding. We want you to stay up to date with yourself. So go in there. Tomorrow too, we will have another session like this, but that will be purely FR and CR. So you can bring your incoming, but it will be just, I'm not seeing it to be a long session. It will just be a short session, the things that you have left. I will talk about the theories, most importantly. So I'll talk about the theories tomorrow, around the same time, 7 p.m. I'll talk about ethics. Somebody brought a question on ethics. I'll talk about that tomorrow. So I'll go through ethics with you because we know that is going to be there. The theories on consolidation, we'll discuss that. We'll go over conceptual framework and regulatory framework, and then any other theories that the examiner will bring up that we would have to think about or talk about there. So that's it about that. I will end here today. And let me go and sleep small. Insurance life matter. So that's it about that. Why are you, Anita? Where is that one coming from? Where is that one coming from? Don't let these boys, Martin and his squad, tell you things. So I don't know where that one is coming from. Now, in case you are thinking what Anita said, go in the chat and go and read it yourself. So that is it. I will end here. God willing, tomorrow we will meet again. I'll run through the theories with you. And then if there are any things you have, I will also deal with you for there. Like I keep on saying, please ensure that you're going to answer the theories first. It's easy. You can take them out. Make sure you build your muscle on the ratios. It's easy. If your grammar is good, you can do the various adjustment that has to be done. You go there. Then certainly the standards, consolidation, the console, my goal for you is getting the free marks on the workings. So prepare your mind like that. I'm repeating some of these things because just prepare your mind so that when you get to the exam hall, you don't get excited. Because when you get to the exam hall, something can come over you, then you are doing console first. Before you know it, get ready to stop work. And or 1 hour gone, and you are still on the console. Then all you start panicking. And then all you start failing. So please make sure that you take away the easy marks first, and then you can go do the hard ones at the end of the day. So enjoy yourself and go to church tomorrow, okay? Those devils, go to church tomorrow, okay? Go and pray. It's just 2 hours. If your church is 4 hours, that one is your own case. Go and pray for the last time. That 2 hours for church or 3 hours for church, nothing will happen. Go and do last prayer deliverance for yourself. Okay, church cry there. Say wakumem. Nyamesum de wakumem. I know that's what you are saying. Whatever be the case, that's it. I'll catch you tomorrow. Good night. Bye.
Against you,
Martin, my formula.